So my name is Matt Turk. I am with Bloomberg Ventures. So in case, or as probably a lot of you haven't heard of Bloomberg Ventures, just one word on this. Bloomberg Ventures is a brand new entity. We've been around for about 6 months. You can think of us as the venture arm of Bloomberg, meaning that we are interested in making investments in pretty much anything that can be synergistic with Bloomberg.
Every month we receive approximately 40 to 50 business plans which are vetted, and the top 10 come in to present to our investors, and then the ones that the investors like get funded.
I see a lot more capital entering the lower level of the ecosystem, probably because of kind of what Charlie was mentioning, and that is that the opportunities for being capital efficient are actually more available now than they were before. And it means that, A, you've got a number of companies that are starting with that only really require a small amount of money, and B, you have a number of companies that are ongoing that also only require a small amount of money. And both of those opportunities mean that folks that normally wouldn't have looked at this kind of side of the world, the angel or the seed or the really, really early, and that, are now actually paying a little more attention to it. So that's certainly one trend.
Just to echo some of those comments as well, I think the bar over the last 6 to 12 months has certainly moved higher for startups. You're looking for higher quality things. I think the term that's been used a few times are also things that are less risk or more de-risked. So I think the take-home from that is, how can you de-risk your idea? And a couple people that I spoke to before this session started, I always try to talk about, and I write in my blog a lot about, which based on originally Josh Koppelman's comments, think about what your 3 to 7 key assumptions are, and how can you turn your assumptions into knowledge as quickly and as capitally efficient as possible. Right? Because before you meet with any of these folks in front of you or any of the people that you're pitching, you want to know what those assumptions are. And in many cases, it's so easy to get rid of assumptions, and you don't need $1 million. Everybody comes up and says, every plan ends the same way, and I need $1 million, and all I need to get is 1%. And I find a lot of times, and I'm starting to see it in more plans, that entrepreneurs are being a lot more clever in how they can kill off assumptions and risks without raising $1 million. So then when you come to pitch, you get a much higher quality pitch, which is important because the bar has moved higher.
1 or 2% market shares in our industry really means failure. Right? If you take a look at all the segments within our marketplace, Oracle would be a primary example, or Microsoft, etc. The market share leader takes an inordinate amount of the capitalization in the space. In the business that we're in, if we invest in a company that gets 1% of a market, you lose.
I think exit strategies is the one thing that you can't control, and I'm always, particularly in this market where the numbers were sort of cited that around where IPOs are and where M&A is, and I think it goes to some of the comments Matt was making at the outset around venture. And venture is a very funny place. It's because of the time lag that exists. Almost by the time you get the data, it's exactly wrong, and you kind of got to be fishing for the opposite thing. So returns may be the worst they've ever been now, but actually it may be the best time to invest. And if you look, fast forward a bunch of years, in retrospect, it'll look that way. By the way, I think we've touched on capital efficiency a bunch of times, and it sort of seems like maybe a directive from the investors, et cetera. Think of it the opposite way, which is it's another way of us seeing how easily and readily you're willing to give away your equity. Capital efficiency is beneficial to the entrepreneur ultimately because you get to own more of the company, and you should in those types of businesses. And if you want to give it away quickly, then and that's one of the most precious things about a company. It raises lots of other questions. But capital efficiency is designed for you, not us.
I mean, I'm amazed how many people are capital efficient on their own dollar, and then when it's mine, they're at market rates.
The other thing I just say related to follow-up is just be careful. What was the expectation of the meeting you were going into? There's the joke in venture capital: if you ask for advice, you get money, and if you ask for money, you get advice. So set up the expectation of the meeting even going into it. You can meet with a VC and say, I'd like to come in to meet with you because I'd just like to hear your thoughts on this. I'm not pitching yet. I'm not ready to pitch. I take meetings like that all the time. I just want your advice, or a phone call for 20 minutes. And then the action items and follow-up is a little different depending on what the ask was.